Welcome to Tax Smarts Unlocked, the podcast for individuals and small business owners looking to conquer the tax landscape with confidence. Hosted by seasoned tax professional David Robson of Premier Tax and Business Services, each episode is packed with insightful advice on proactive tax planning to help you navigate the complexities of tax laws. Here's your host, David Robson.
Hello, and welcome to Tax Smarts Unlocked. I'm David Robson, and today's episode is the Tax Balancing Act. Are you playing the game right? We're tackling one of the most misunderstood parts of personal finance: how and when you actually pay your taxes. Spoiler, it's not just an April thing. Whether you're a W-2 employee, a 1099 contractor, or you run your own business, you live under a pay-as-you-go system. Money is supposed to reach the IRS throughout the year, not in one dramatic dump at filing time. Get the rhythm right and life feels smooth. Miss the beat and penalties, interest, and cash flow headaches creep in. I'm going to decode why some people cheer big refunds while others grit their teeth writing checks, and how to align your approach with what you truly value: predictability, precision, or maximum cash on hand. There's no universal right answer. There is a right answer for you. We'll break down the rule books for employees, contractors, and self-employed folks, highlight the traps that trigger surprise balances, and map out 3 legitimate strategies: the big refund camp, the break-even camp, and the hold your money as long as possible camp. Along the way, I'll share tools, deadlines, safe harbor rules, and a few field-tested tactics so you can choose, adjust, and avoid unnecessary penalties. Pour a coffee, open your notes app, and let's make this the year your tax payments match your goals, not your guesses. By the end, you'll know your numbers, your options, and your next move with confidence today. Let's start with the foundation: pay as you go. The U.S. income tax system expects you to send in tax during the year as you earn money. For employees, that usually happens automatically through paycheck withholding. For contractors and business owners, it happens through estimated quarterly payments. The goal isn't to make tax season exciting, it's to keep the government funded while keeping taxpayers on a steady path. Why does this matter? Because underpaying during the year can trigger penalties and interest even if you pay everything by April. Think of it like your utility bill. Ignore it for months and you'll owe late fees, even if you eventually make the full payment. The IRS works the same way. Overpaying during the year, on the other hand, yields the famous refund. That refund is not a bonus. It's simply your own money coming back, interest-free. Here's the simple truth: a refund means you overpaid during the year. A balance due means you underpaid. Neither label makes you smart or sloppy. It just describes the timing of your cash. The art is deciding which outcome you want and then engineering your withholding and estimates to get there while staying penalty-free. The rules sound dry, but the payoff is big. Less stress, fewer surprises, and cash flow that actually matches your life. Once you see tax as a year-round routine, not a seasonal emergency, you gain control. That control frees resources for goals like debt payoff, savings, and smarter business growth today. For traditional employees, the main lever is the Form W-4 you give your employer. That form tells payroll how much federal income tax to withhold from each paycheck. Since 2020, the W-4 asks for dollar amounts and job information instead of the old allowances. If your withholding matches your eventual tax, you'll land close to zero at filing. Common reasons employees get big refunds: over withholding because the W-4 wasn't tailored, having multiple jobs that each withhold as if they're your only job, or never updating after life changes. Marriage, divorce, a new child, buying a house, or losing a dependent can all shift your tax picture mid-year. If your W-4 doesn't reflect that shift, you may be giving the government an interest-free loan. Common reasons employees owe: under withholding from claiming entries that reduced withholding too much, side hustle income with no withholding, or large one-time payouts like bonuses, stock vesting, or retirement distributions that didn't have enough withheld. Many companies withhold bonuses at a flat rate that may not match your actual bracket. What to do? Use the IRS withholding estimator. Enter all jobs and income and update your W-4 anytime your life or pay changes. If you're juggling 2 W-2s, use the multiple jobs section carefully. It matters. And remember, withholding is not forever. You can file a new W-4 in July just as easily as in January. Dial in the form, and your paycheck and April results start playing the same tune. Your future self will thank you. Contractors and freelancers live in the 1099 world. Clients pay you gross, no tax withheld, and at year-end, they issue forms 1099 NEC or 1099K reporting what they paid. Beautiful for cash flow until April arrives and you realize no one sent the IRS a dime for you. That's your job. Two big realities define this world. First, you owe income tax on profit, not gross receipts. Track expenses diligently: software, supplies, mileage, home office, professional fees, because deductions shrink taxable income. Second, you also owe self-employment tax, which covers Social Security and Medicare. Employees split those costs with their employer. As a self-employed taxpayer, you pay both sides, roughly 15.3% on net earnings up to certain limits, plus Medicare above that. Forgetting self-employment tax is a classic reason contractors get walloped with balances due. Without withholding, the system expects estimated quarterly payments. We'll unpack those next, but the mindset starts now. Every payment you receive is not all yours. A portion belongs to future you and the Treasury. Many contractors protect themselves by sweeping a set percentage, often 25 to 35% of each deposit, into a separate tax account the same day income hits. Out of sight, out of temptation. Finally, don't confuse having multiple clients with having a corporation. Your structure, sole proprietor, LLC, S corporation, affects how tax is computed and paid. If your income is growing, talk to a pro mid-year about whether an S corporation election could reduce self-employment tax. Timing matters, and so does payroll compliance. Plan early, avoid expensive surprises. Let's talk estimated quarterly payments, the lifeblood of staying square when no one withholds for you. The IRS looks for 4 payments tied to earning periods, generally due April 15th, June 15th, September 15th, and January 15th of the following year. Weekends and holidays can nudge dates, but the rhythm stays. You can pay electronically through IRS Direct Pay or EFTPS, both free. How much should you pay? You have 2 main paths. 1. Aim for 90% of your current year tax, adjusting as income shifts. 2. Use the safe harbor. Pay in at least 100% of your prior year total tax, 110% if your adjusted gross income exceeded $150,000, or $75,000 if married filing separately. Hit safe harbor and you'll generally avoid underpayment penalties, even if you owe a balance in April. What if you miss or underpay? The IRS calculates a penalty like interest for the underpaid amount for the period it was underpaid. It's not moral judgment, it's time value math. Late payment in April doesn't erase underpayment for earlier quarters. Conversely, paying extra in December doesn't retroactively fix June. The fix is to adjust now, not later. Pro tip: pair estimates with a monthly habit. Each month, update your profit, set aside your set percentage, and if a quarter is closing, make the payment early. Calm beats calendar panic. If your income is seasonal, consider the annualized income method on Form 2210 to match payments to actual earning patterns. This method often reduces or eliminates penalties entirely. So here's the big perspective shift. Employees, contractors, and business owners are all playing the same game. Tax has to reach the IRS during the year, but each group uses a different rule book. Employees steer with withholding. Contractors steer with estimates. Many small business owners do a combination of both. The destination is identical, enough timely payments to avoid penalties, aligned with your cash flow goals. Let's kill a myth. A big refund does not mean you won. It means you paid too much in during the year and the government held the excess interest free. Also untrue. Owing in April doesn't necessarily mean you did something wrong. It can simply mean you chose to keep more cash during the year and still met safe harbor. The only wrong is racking up penalties unintentionally. Why do smart people still get thrown off? Life changes mid-year. You get married or divorced. A child is born. A dependent leaves for college. You start a side hustle or switch jobs. You exercise stock options, sell an investment, or take a distribution. Each event changes your tax picture and often your withholding needs. If your inputs don't change, your results will. This is why a mid-year check-in is gold. A quick projection in June or September can reroute a looming surprise into a non-event. 10 minutes adjusting a W-4 or sending an extra estimate can erase hours of stress later. Taxes reward intention far more than endurance. Choose your target, measure monthly, and correct course without drama. Let's explore the 3 camps, all valid when done intentionally. Camp 1. The big refund crowd. You like a forced savings plan and the feel-good check in spring. The trade-off? You're lending the government money at 0%. If you struggle to save on your own, this may be acceptable. Just recognize it's a behavioral hack, not a financial return. Camp 2. The break-even purists. Your goal is to file and see almost nothing owed and almost nothing refunded. This is the most financially precise outcome. It keeps your cash earning for you during the year without creating a bill to scramble for. To get there, project your income, adjust your W-4 or estimates quarterly, and tighten the screws in the fall. Camp 3. The hold your money as long as possible strategists. You want cash in your pocket until the last legal moment. The key is mastering safe harbor rules. Generally, pay in through withholding and estimates at least. 100% of last year's total tax. 110% if last year's AGI was over $150,000, or 90% of the current year's tax. Hit 1, and you likely avoid penalties, even if you owe in April. Farmers and fishermen have special 66 2-3% rules. If that's you, get tailored guidance. Pro tip for Camp 3, favor withholding late in the year if needed. Withholding is treated as paid evenly all year, but estimates are dated when paid. A late year withholding bump can clean up earlier shortfalls. Coordinate with payroll or retirement distributions to implement effectively. Let's make this practical with tools and habits. IRS. Withholding estimator. Plug in all jobs, credits, and other income. It produces W-4 entries you can hand HR. Revisit after promotions, a new child, or a second job. Separate tax account. If you're 1099 or self-employed, sweep 25-35% of each deposit the day it lands. Treat it like payroll for your future tax bill. Bookkeeping rhythm. Categorize income and expenses weekly. Good books create accurate estimates and reveal deductions you might miss. Mid-year projection. Meet a tax pro in June or September. Bring year-to-date books, pay stubs, and plan changes. A 45-minute review can save months of anxiety. 2 quick examples. Casey, a nurse with 2 part-time W-2 jobs, got a $4,800 refund. Each job withheld as if it were Casey's only job. Using the multiple job section on both W-4s reduced over-withholding and added $400 a month to cash flow without creating a bill. Jordan, a designer on 1099s, owed $9,000 and $450 in penalties. The culprit: no set-asides and forgetting self-employment tax. We opened a tax account, auto-transferred 30% of each payment, and turned on quarterly EFTPS reminders. Next year, small balance, no penalties. A big refund can hide sloppy cash management, overspending all year, then rescuing yourself with your own money. A balance due without a plan breeds debt and interest. Choose intention over inertia, and let the math serve your goals. And remember, tax planning is a year-long habit, not a season only. That's our tour of the year-round Tax Balancing Act. We covered pay-as-you-go basics, how W-4 withholding works for employees, why contractors live by estimates and self-employment tax, and how self-employed taxpayers use quarterly payments and safe harbors to avoid penalties. We untangled why refunds and balances happen, how life events scramble the math, and the 3 legitimate strategies: big refund, break-even precision, or hold your cash with safe harbor discipline. Here's the headline. Refunds and balances are just timing. The win is choosing your target and steering toward it on purpose. When you pair good information with a simple routine, the system stops feeling mysterious and starts feeling manageable. It's not designed to confuse you. It just asks for a little attention along the way. Your one action step today: pick a lever and pull it. If you're an employee, run the IRS withholding estimator and send an updated W-4. If you're a contractor or self-employed, open a separate tax account and sweep a percentage from your next deposit. If your life changed this year, schedule a mid-year projection with a professional. If this episode added clarity, or at least lowered your blood pressure, share it with a friend who's dreading April. Subscribe to Tax Smarts Unlocked so you don't miss future episodes on deductions, entity choices, and moves that keep money in your pocket legally. I'm David Robson. Thanks for listening and choosing intention over surprise. Until next time, keep your numbers current, your payments purposeful, and your plan aligned with what you value.
Thank you for joining us on Tax Smarts Unlocked, the ultimate podcast for individuals and small business owners ready to conquer the tax landscape with confidence. Hosted by seasoned tax professional David Robson of Premier Tax and Business Services. Each episode has been carefully crafted to provide you with insightful advice on proactive tax planning. By adopting a smarter tax approach, you can focus on what you do best, growing your wealth and your business. We're here to guide you every step of the way. Don't miss an episode. Subscribe to Tax Smarts Unlocked on your favorite podcast platform and unlock the secrets to confident tax planning. Remember, it's time to take control of your taxes and unleash your full financial potential.